Hello, my name is Manny Kagan. I'm a founder of Money Solutions Academy, and I'm privileged today to have very special guests. They both work for Flagstar. Flagstar is a mortgage bank who's been around for, I don't know how many years, maybe they'll tell us how many years. And Anne Heinz is, she is the representative, and we're working very closely. And today, because it's a construction lending subject, I have to learn as much as you will. And so Anne and Neil will discuss this, and I'll just listen, and maybe I'll interrupt them, and maybe not. Okay, Anne, it's your turn now.
Hi, my name's Anne Heinz. I'm an account executive with Flagstar Bank. Manny, thank you for having us today. And with me today is Neil Childs, and he manages our construction division. And we're here to just talk to you a little bit about how we do these construction loans, what we have to offer, and just have a little dialogue.
How long Flagstar was in business?
We've been here since 1987.
Wow. So you, as long as almost, because I started Pacific Bay Financial in 85. So this is how long I know you guys. Wow, incredible.
Yeah.
Okay.
We've been in business a long time. So yeah. So we have a couple products we want to talk to you about today as far as we're going to specifically speak about construction, but we have a one closed construction, and just to define construction loans a little bit, what it is it's one application, one rate lock, and one set of fees. This is what we offer, and it's called a one close, which occurs before the construction term begins.
Which
so they're the construction loan and the end loan financing.
Okay, so which is the difference is when people go to different banks, and we have a number of banks who offer construction loans. You have to get construction loan, and then after construction is over, you have to take takeout loan. In your case, you're saying you don't have to bother. You start with and you finish with the end product.
Correct. Exactly, and thank you for explaining that. What it is, not what Flagstar offers is that. What another product might be is a loan that requires an interest rate through the construction completion. These are not temporary loans. These include the financing of the building of the new home, and then they convert to an amortized mortgage. So again, going back to what we offer, it's one application, one rate lock, and one set of fees, and one closing, which occurs before the construction even begins.
That's interesting. I have a question because it comes to mind. Usually construction loans are priced based on prime rate. This is a common among banks. So if you are locking the rate, how you define the interest rate?
Well, the interest rate would work just like any other mortgage that you would be getting. As Anne mentioned, you don't actually have to lock a rate through the entire term, which can sometimes be 12 to 18 months for that construction to be built. The rate needs to be valid through closing, just like any other mortgage would. So once that loan closes, that is the rate that the borrower is going to continue to maintain. And during construction, the borrower is only going to have to pay interest on the amount that they've drawn on that line. And when we modify the loan, at that point, it becomes a fully amortized mortgage equal to a normal 30-year loan. So they're not having to reclose, and that rate is only going to have to be valid through the closing of the original transaction.
Okay, that's very interesting comment, because it means that when interest rates are high now, you don't have to lock the rate. You can really float. You can wait until you're getting closer. So can you lock rates somewhere in the middle of the construction project?
No. Let me back up. The rate is guaranteed at loan closing. So once you sign that paperwork before we even start construction, that is the rate that you're going to get. So you don't have to be concerned about rates going up during that 18-month period of construction. Okay. So one of the good things about Flagstar, you are always pricing your loans well. So it means that there's a good chance that it's going to be, well, interest rate will be quite low at that time, which is good news. And you mentioned that you can do conforming loans as well as jumbos, correct?
Correct. We have a one closed construction loan, which is our conforming. This allows for conforming and high balance loan amounts, primary residences, and second homes. And again, only an interest only payments made during the construction period. And it's a 9 and 12-month construction term.
So
Available.
how do you define interest rate? You said interest only pay, but how you set up interest rate? I pointed out before that usually it's prime plus rate. How you defined it?
As far as the go ahead, Neil.
Neil?
As far as the interest, it's priced just like any other mortgage would be. So we would price that loan out just like you would for any other product that we would have. And that's the rate that you're going to be closing with. It's not necessarily, it would be tied just like any other rate that we have to our product guidelines.
Okay, so basically what you're saying, whatever rate, like if you're getting any kind of loan today, whatever rate
Correct.
today, this is the rate will be set up at the beginning of transaction, and it will be interest will be only paid on the draw, and it's going to be interest only, correct?
Correct.
Correct. Okay, perfect. So by the time when finish work is done, you're getting a new loan, which will be permanent. You don't have to go through new paperwork. Perfect.
Correct. And the best part is it's not even a new loan. It's the same original loan. We're just modifying that to the permanent phase of that mortgage.
Wonderful. And then how do you appraise value? What do you determine value based on today's value or the future? How do you define how much property will be worth?
Well, there's a couple of them. So the LTV loan to value will depend on the loan purpose type. So the purpose type's construction, if the borrower does not own the land, and they will be purchasing it with the proceeds of the loan at the time of application. Okay, so if the borrower's already on the land at the time of the application, then it's a construction to perm. So there's two. We don't do lot loans, but you can purchase the lot with the construction as well, or just do the construction. Construction, if that makes sense.
So
and
let's
the value itself is always going to be the projected value based on the
Correct.
plans and specs.
the future value.
Correct.
Yes.
Yeah, okay, very good. I think it's similar to fix and flips where you also
Correct.
do construction and you evaluate on the future value.
Mhm.
Yeah. And the difference fix and flip, you need to get new loan or to sell a property at the end. Okay. So give me an idea what rates might be if it will be today. If I have everything, I'm ready to go, what will be rate today? Just I will not wait for that.
Well, that's something we're going to have to probably get back to you on because it absolutely changes daily. But
Yes.
probably like, again, we have a one close, we have a jumbo fix, we have a jumbo arm, depending on the product. I would recommend, obviously in your area doing a jumbo arm
Yes.
loan. And the rates tend to be around the 9s, 8 to 9s.
Okay,
So that's
this
where pretty much you're
in
at.
okay, this is in the line of construction loans in general, because
Correct.
construction loans, it's prime plus. Usually it's prime
Correct.
plus 1. So if you talk about prime today, 7.25, I think it's didn't go up to 7.5. I don't remember even. Then you're talking about plus 1, it'll be 8.25, 8.5.
Around there. Yeah.
Yes, it's the same interest rate which you'd have if you can get construction loan.
Correct.
Yeah. And so you have limitations on loan to values because this has to do with the construction loans anyway.
So your
As
loan to
far-
value, the loan to value is going to be based on if it is construction or construction to perm, like Ann had mentioned previously. So if the
Right.
borrower is buying the lot with this loan, they don't currently own that lot. The LTV is going to be based on the acquisition cost, which would be your construction contract and the lot cost. It's going to be the lesser of that acquisition cost or that projected value I mentioned earlier from your appraiser.
Yeah, the loan to cost, basically.
Correct.
Yeah.
Correct. If it's construction to perm, meaning the borrower currently owns that lot, they just want to build a house there. It is truly based on just the projected value.
Okay. I have, as a matter of fact, I have 2 clients who might fit in this parameter right away. Somebody who owns a property with adjacent lot, which is buildable lot. So in this case, which you described, he might be able to just build a house and get financing for that.
Yep, exactly.
Yeah. And how about qualifying? Are you using conventional qualifying criteria?
Yep. Yep, we sure are. For our conforming loan, it would follow normal conforming guidelines for qualified.
Yes. Okay, perfect. Because one of my concerns always when I deal with clients who need construction loans, takeout. Because I always want to be sure I will be able to get them takeout loan. Now they have to be qualified for a takeout loan. Now,
Nope. Right. And that's the best part about this is there's only one time that that borrower has to qualify for you. We take care of everything else at the end.
Yeah, but you qualify at the beginning and then you just change the interest rate according to the market conditions then.
Mhm.
Okay.
And let's talk a little bit about the beginning process. When you're talking to your borrowers, first question out of your mouth would probably be, do you have a builder? It's like, that's where we start. We don't even need to get to the loan or get anywhere, but you know, people are always shopping for their builders. It's like anytime you can start there. So we have a group of forms you can give to your borrower, they can give to the builder, and sometimes that takes a long time to actually get the builder to stop, fill out the papers, get it, because he has to get approved with a company called Granite Construction. So it's a great place to start there. Again, you don't even need to wait for the loan to start when you're working on your builder. So I wanted to make sure that we cover that because that is the beginning piece.
So in other words, if client says, I would like to build, what I need to do to start the process?
If I want to build, you say, do you have a builder in mind? And we give you the information to find the builder. That is the number one place
to find a builder.
start.
But let's say if they already have a builder, then I need to give to builder a certain piece of paper, which they have to
Absolutely
fill it up and then to get approved, and then we can continue.
Correct. As soon as they have a builder, you give them the paperwork and they can start working on the paperwork, and it's a separate company, Granite Loan Management Company.
Yes,
They would fill out the information, send it in, and we can get your builder approved while we're working with the product.
But this Granite, are they working all over, let's say, Bay Area? Where are they?
All over the United States right now.
Oh, I see. So it's large company. Okay, interesting. I didn't have this issue before. All
Yes,
right.
it's a great place to start without
okay.
even starting your loan.
Yeah, so this will be an excuse for me to call you and ask you, how are you? Okay. So point.
Absolutely.
Yeah. So whenever somebody says that I want to build, I'm asking the question, do you have a builder? And what if it's a just beginning stage before builder? Let's say just dealing with architect. There's no builder yet. Now, they want to first to figure out what they're going to build and how much this will cost. What do they need to do at that stage?
At that point, before they're able to really start that mortgage process, there does have to be a builder in place because we would need an actual contract with the builder, a third-party contract.
Okay, and now my recommendation would be when you're dealing with architect, you start thinking about which builder is going to build. It can be recommendation from the same architect or whoever, but we have to have this in place because otherwise we cannot move forward, which makes perfect sense because they'll define scope and cost of the construction. Yeah.
Correct.
Okay.
That's where you have to start. You can't go any further without researching who your builder is and just asking around, asking in the area, who are the good builders, so
and
yeah,
if they
that's
have time,
number one.
And if they have time, it's another time.
Yes. Some builders are super quick. You give them the paperwork, they get it done, boom, we get it off. And some builders,
I'm talking about availability times. They have to be available.
Yes.
Yeah.
Yes.
Okay, then I touched up before we started this about ADUs, auxiliary dwelling units. And Neil, you told me that you can do it and you have ways how to finance it.
Correct. Our one closed loans also are used for renovation as well. So you can use that renovation category to be able to build an ADU as well.
Perfect. So I think that in general, I received answers to a lot of questions. I still have to deal with the specific questions, but I know what I need to do to start. How can I help my clients? I want to thank both of you, Anne and Neil. And to my viewers, I want to point out that we're not sitting in a conference room. each sitting in our own places. And by technology allows us to have this viewing like we're sitting together. Okay, so until next time, my name is Manny Kagan. I'm going to help you, I promise. Thank you very much.
Thank you, Manny.
Thank
Thanks,
you.
Manny.
Thank you, Neil. Okay, bye, Ann.
Bye.
Bye.